Friday, July 23rd, 2021, Monaco 64, home of alternative economics and contrarian views. Yes, I have been warning people for the last year about inflation. And why am I warning you again? Well, because I think it's going to get really bad. It's going to be even worse. Of course, inflation has been baked in the cake ever since the Federal Reserve was founded in 1913. The purchasing power of the dollar has been dropping very steadily, steadily down. And that's what inflation is. It's the debasement of the currency. It's not price increases. Price increases are the consequence of inflation. And I'm hearing some very comical comments nowadays, not only from politicians, but of course also from central bankers, because they're not there to help the public, even the Democrats or the Republicans or the Tories or Labor. They're part of the same team to basically extract as much wealth from you as possible. They're put there by the bankers who benefit massively from the inflation because they act as agents for the government, and they are always raking in the funds, the inflation. They are getting rid of the phony money and putting it into assets quicker than all of us can do. So before I go further and we look at some of these comical comments, actually, from people like Joe Biden, people like Alexandra Ocasio-Cortez, and comments also from a Bank of England official, we're going to refer back to my old Merriam-Webster dictionary from the 70s. It used to be my dad's. I kept it after he passed on, unfortunately. Well, that was 1998, so it's been a while now. But I always like to refer back to this dictionary because that's been one of the things that they've been able to do is change the definition of words. And that's really serious because inflation is basically theft. And I'm also going to refer to Felix Sommery, who spoke about inflation. But nowadays, we're told that inflation is rising prices. They never talk about the fact that it's the money printing, the creation of money and credit out of thin air. So that's why I like to go back to the 70s, which was a time when things hadn't gotten as bad in terms of the propaganda. So it says here, inflation, an abnormal increase in the volume of money and credit, resulting in a substantial and continuing rise in the general price level. Of course, prices flow to different places at different times, at different paces. That's the Cantillon effect, of course. So I'm going to share with you here. This is a PDF from the Raven of Zurich. I highly recommend this book. I'll put the free PDF in the description of the video. I think it's very expensive to buy this book. I've got a copy. I bought it many years ago. I'm keeping a hold of it. So if you go to page 98, The Raven of Zurich, it's the memoirs of Felix Sommery. This is what he says about inflation. That did not prevent the wide dissemination of this deposit myth. Myths generally spread wider and last longer than knowledge of mere facts. The state alone is responsible for inflation. Inflation without government, or indeed against government, is impossible. So there you go. Who was Felix Sommery? Well, he was one of the most respected bankers of the first half of the 1900s. He advised governments kings. He advised the U.S. Treasury. He advised the Bretton Woods conference, not directly, but behind the scenes. Very respected banker. He was born in Austria. He moved to Switzerland, and then during World War II, or just after World War II, he moved to the U.S. So with that, I wanted to play this clip here. It's Ocasio-Cortez talking about inflation, and you see that she's got no clue. She's actually asking for more inflation. She calls it infrastructure spending, but we know that infrastructure today is like universal basic income. It's got very little to do with what infrastructure used to be in the past, but let's listen to it.
Today, I'm sure you saw, what happened with the stock market. They said it was because of COVID, but there was lots of talk about inflation. So I want to talk about the fears of inflation. President Biden pushed back, assuring Americans that the price increases that they've seen hitting their wallets are temporary. Now, last week, you questioned the Federal Reserve Chairman Jerome Powell and expressed concern over prematurely raising rates and what that could mean for marginalized communities. What are your biggest concerns over inflation, Congresswoman?
Well, here's the deal with inflation is that if we do not get the root cause of these price increases right, then policy decisions could be made that could really negatively impact your life, boost unemployment, and again, increase interest rates. And we do not want that. So it's really important that we get the diagnosis right into what's going into these price increases. When you look at what actual prices are going up, it's in very specific sectors. If this was an overall inflationary issue, we would see prices going up in relatively equal amounts across the board, no matter what the good is. But we know what's getting expensive. Things like the cost of lumber, items like cars, whether they are new or used, and other sorts of items that rely on shipping and shipping containers coming in from overseas. These are very sector specific, which means that these are due to supply chain issues. That means that we don't have enough ports that can accommodate all of the backed up ships that are trying to come in. It's because we don't have enough computer chips that are produced by just a handful of factories in the world that go into these vehicles, which are then causing a rush on used vehicles. And it's because of all of the rush on demand to build and to remodel homes during lockdown. And the reason it's important for us to understand that is because the solution to that is, guess what? Infrastructure. Yeah. We need to put in more money and more funding. More money. So we expand ports so that we can add resilience to our supply chain. That's what we can do if we get it right. We actually support these infrastructure investments and make sure that we protect not just the size, but potentially make it bigger. Now, if we get it wrong, if we say this is inflation, that this is an inflationary trend, etc., what's going to happen if we get it wrong? We put policy pressure and political pressure on the Fed to increase interest rates, which will drive up the rate of unemployment, which is the exact opposite thing that you want to be doing in such a fragile state of our economic recovery post-COVID. Okay. So that's why it's so important that we get this right and put the politics aside.
So there you go. No mention of the government and the fact that the central bank and the government have been stimulating not only monetary policy, but fiscal policy, of course, for the last 14 months or so. The trillions of dollars in money and credit that have been created. No mention of that by Ocasio-Cortez. She doesn't know the definition of inflation. She's blaming rising prices for inflation. She's blaming lumber. Yeah, they love doing that, blaming things for inflation. My analogy is like, if you're overweight, you can't blame your tummy for being overweight. You have to blame yourself for eating too much, for not burning enough calories to keep your weight stable. So Ocasio-Cortez basically is blaming the result of inflation for inflation. So just wanted to prove to you that money and credit are rising and have been going exponential, as you can see here. This is M1. This is the new M1 from the Fed. they still can't hide the increase. So, I mean, no mention of that by Ocasio-Cortez. And she also noted that the economy wasn't doing well, so we need even more inflation. What that's going to do, it's going to make the economy even worse for the people that she's supposed to represent, because inflation hurts the people at the bottom, because unlike very wealthy people, they can't protect themselves from inflation. They don't have the savings or wherewithal to buy tangible or hard assets. They're struggling to survive every month because prices are rising. So let's look at M2 now, not just M1. So I'll share M2 with you as well, just to show you. Yeah, there you go, M2 as well. You notice how it's just picked up massively, the rate of increase since last year. Now I wanted to play Mr. Biden, President Biden. This is what he said about inflation. That he's using the transitory excuse as well. So let's listen to him.
The economy has come roaring back. We've seen some price increases. Some folks have raised worries that this could be a sign of persistent inflation. But that's not our view. Our experts believe, and the data shows, that most of the price increases we've seen were expected and are expected to be temporary. Reality is you can't flip the global economic light back on and not expect this to happen. As demand returns, there's going to be global supply chain challenges. We've seen that in semiconductors, which are used in automobiles. That global shortage has slowed vehicle production, creating.
So I'm going to stop here because you get the idea. Blaming everything but themselves, not talking about the trillions in stimulus. Yes, the economy comes back. Economic activity picks up. But if you have a healthy economy where people are producing, it shouldn't be inflationary. The more goods you produce, the less inflation there should be. The problem is that there's too much money and credit in the system. So with that, I want to now go to, because it's not only politicians that try to fool us about inflation, but also central bankers, also economists in the city of London and on Wall Street. So here we have a Bank of England official. It says UK inflation risk hinges on wage growth, warns BOE official. So this just sounds like it makes you believe that wages create inflation. And they use that old chestnut. They say that in the 70s, it was the unions that created inflation because they demanded higher wages and got higher wages, but they never look at themselves. The fact that they are creating money and credit out of thin air, ad infinitum, that they have rates at 0%, that is inflation. And I think these unions and people who represent workers, they need to do a lot of homework about this, because what they're going to do if they don't ask for the right things is they're going to get even more inflation, and it's going to spiral out of control. So it says here, rapid price rises for consumer goods are unlikely to last. So they're all into this agenda or narrative of transitory. But UK rate setters will have to watch out for signs of wages increasing at a pace that could lead to more persistent inflation. Another big fat lie there, because as we know, inflation is created by government with the help of the monopoly created central bank, through monetary and fiscal stimulus, through deficit spending. And we know the deficit reached almost 20% in the last fiscal year here in the UK. The government is out of control. It's also out of control in the US. And it was out of control prior to the current administration. Prior to the crisis last year, the budget deficit in the States was running at 5%. So I've got no political preference because both sides of the aisle anywhere in the world are playing the same game. Don't forget, it was a Republican that took the world off a gold standard, off sound money almost 50 years ago. So Ben Broadbent, Deputy Governor for Monetary Policy, acknowledged that the extent of the rise of UK inflation was hard to explain. Well, it's not hard to explain, Mr. Broadbent. you know, just look at yourself in the mirror and what you guys have been doing for the last, well, I would say 13 years since '08. You guys have been inflating like mad, and you've been inflating even more in the last 14 to 15 months. Average over the past 18 months, it has been only slightly lower than before the pandemic, even though gross domestic product is still well below its pre-crisis level. Well, the reason for that, Mr. Broadbent, is that you've created the stimulus. You've put funny money into people's hands for not working. And that's why you have higher prices. You shut down the economy. Yes, there are disruptions, but people don't want to work. A lot of people don't want to work. They want to stay at home if they're getting their furlough or whatever. There was a good case to argue that some of the contributing factors would be temporary, he said. In particular, the global surge in goods price inflation should slacken as consumers switch back to spending on services and supply bottlenecks ease. Well, it doesn't look like they're easing. I spoke about yesterday about the shipping problem with seafarers. It's only going to get worse. There's too many. As I said, these people are trying to fool you, but let's continue. Even though inflation is likely to rise further in the coming months, and actually what he means is not inflation, it's prices continue to rise. And that's how they get you, because they tinker with those measures of prices and they say, oh, inflation is lower. The appropriate policy response could well be nothing. There you go. They don't want to do anything. They want to keep inflating. If this was only a story about global goods prices, and here's the funny part, very comical, at least for me who knows what inflation is. Of course, a lot of people are going to buy into this, unfortunately. They're going to blame higher wages for low-paid workers for the inflation. They never blame inflation when politicians give themselves like 10% pay rises, or when Jamie Dimon or other people on Wall Street in the City of London get huge bonuses. That's not inflation, right? But when it's you or lower paid workers, it's inflation. So here it goes. But he warned that policymakers would have to pay very close attention to the numbers in the labor market, because inflationary pressures in the domestic economy could be more persistent. So blame it on the labor market, blame it on labor shortages. Never talk about the fact that you're creating funny money and credit out of thin air. So I think that's enough for inflation for the day. So what's the way to protect yourself against inflation? Well, it's very hard, of course, especially if you are on a fixed income, if you're a pensioner, especially if you are lower paid, or even if you're not lower paid, if you're not like a high flying executive, or if you're not a politician. It's very hard to keep up with prices rising, and I think it's going to continue. The only thing that's temporary, I think, is the narrative that it's temporary, because they're going to have a trouble hiding this inflation, and they're trying really hard to do it. So with that, Let's quickly look at where the markets are this morning. So I'm doing my video today on Zoom, and so I can share these pages with you, so you can see what I look at when I give you where the markets are. So as you can see here, it's 8:08 a.m. London. We've got spot gold pretty much unchanged at 1806. The low's been 1801 and the high 1810. So why haven't gold and silver done better? We're supposed to have inflation. Well, inflation, as I said, is the creation of money and credit out of thin air. So last year, in March, they started inflating massively the Fed's balance sheet, M1, M2, and actually gold went from 1450 to over 2000 in a matter of months. It actually telegraphed or warned us about the price rises coming. That's what gold did. Does that mean that it's going to stop now because we've had the price rises? No, because the inflation is going to continue. As you see, Keynesians think that inflating even more is the solution to inflation, because they don't know that inflation is the creation of money and credit. Inflation is deficit spending, and it will result in a lot higher prices. So yes, there are only really two kinds of money that protect you from long-term inflation, and those are gold and silver, and they've done it through the ages for thousands of years. I'm not saying you're going to have to wait thousands of years, of course, for gold and silver to protect you, but just think that back in 2002, gold was trading around $250 or $300, and many people consider the period since then a period of moderate inflation. And despite that, gold has done really well. So has silver. And silver last year got down to 11 when everything imploded in March. And then we had the inflation, the beginning of the inflation. And silver reacted by going to 30. So we need to be patient. We need to realize as well that having gold and silver is more than just protecting our wealth, as I said, or savings, as I said yesterday. It's about not financing this crazy policy of inflation from governments and central banks. So silver this morning is down 6 cents, as you can see here, 25.35. High has been 25.50, the low 25.22. Just show you a chart of silver here. Yeah, you can see there's a trend line here, and it's part of a triangle. Let me draw the other trend line. So, or a wedge or a pennant, whatever you want to call. So this is a monthly chart, and as you can see, I think we're holding this. Let's see. Let's draw this better. Yeah, we're pretty much holding the bottom of this pennant, as you can see. So yeah, still winding, and a pattern like this normally results itself in the resumption of the prior trend, which was up. Yes, there's a possibility that we could go down, but with all the talk of inflation, the fact that they're going to keep inflating, of course they don't call it that. I'm pretty much convinced that silver will eventually break through the top of that pennant and blow through 30 very quickly. Yes, it's taken longer, but we need to be patient, I would say. So what about the rest of the markets? As you can see, the Dow is up 83, the NASDAQ is up 40, the S&P up 16, the FTSE is up 50 points, just above 77,000, sorry. And the currencies, you got sterling down about an eighth at 137.51. The euro is unchanged. The dollar is up slightly versus the yen there at 110.34, and the dollar versus the yuan is up slightly as well at 647. Let's look at the other FX rates. So we've got the Aussie dollar down 0.25% at 73.64, and the dollar is up slightly versus the Canadian at 125.71. So WTI crude is unchanged, back above 70, 71.75. High grade copper up 0.1%, almost at 434. Well, around 434. Just wanted to show you the coffee chart, because they've had pretty bad frosts in Brazil over the last few days. I think it was the beginning of the week. So if you look at, it's not just lumber now, it's coffee as well. And yes, this is because of the frost. So we went from 160 to almost 200 in a matter of days. But notice how since last year, coffee's been going up as well. Well, that's the inflation. That's the consequence of inflation. So let's finish with the bond market. Let's look at the 10-year yield. So I'm sharing this with you here. This is from investing.com. As you can see, this is the whole yield curve here, but we usually look at the 10-year yield. You see it's up 2 basis points, just below 129, 128.80. You can see where the other rates are. The 1-month rate is almost at 0. The 2-year yield for the 2-year note is at 0.2, and the 30-year is just below 2 here at 192. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.